Hey, what's up, good people? How you doing? Welcome back to Stock Up with Larry Jones. You know already. Go ahead and hit the like, subscribe, and notification bell if you're just joining the family. Make sure that your subscriptions are checked dark. Okay, make sure you're not unsubscribing. I keep saying that in my views. A lot of people have noticed that they were mistakenly unsubscribing, and so my views have been coming back. Thank you so much. Another red day, good people. Another red day. It's a continuation of last week. The most of last week was a sell-off. We're still selling off based on the Fed. Everything is Fed induced, right? And so we know that the Fed, even the Fed knows that a recession is coming. When exactly, no one knows. So I want to talk about a few things about different ways of trading. And I want to show you someone else's point of view, that pay grade, or should I say his education, I believe is a lot higher than mine. We're going to listen to what this gentleman has to say, and then we're going to go and I'm going to tell you what I think. Okay, so listen, there's so many different ways of trading, right? You got day traders, you got swing traders, and you got investors. They're all different. And there are different types of day trading, different types of swing trading, and there's different types of investing. Some people won't touch a stock unless it is paying dividends. Some people only do what's called value investing, meaning the PE ratio, price to earnings, is lower than the average of 15. So they look for stock that are oversold. So PE ratios of 10, 7, 5, and even 4. So they find those type of stock. And what area, you know what I'm saying? Is it a growth stock? Is it banking? Is it consumer discretionary? So there's so many different ways to make money in this market, and there's not one that works for all. All right. So I want to dig into this interview. I want to go over a few things. So let's just say this right now. Let's look at this. All right. So the British pound is at its lowest. Excuse these allergies. They got my eyes today. All right. The S&P, it could hit its 200-day moving average. We'll discuss that in a little bit. Gold hit its lowest level since COVID, since 2020. And I am buying a little more soon as I get off of this. I just want to let you guys know I am buying some more gold. The fact that it's its lowest since 2020, I'm buying a little more. I don't expect it to be green for the rest of this year. I'm fine with that if you understand that the dollar is still up. Dollar is hitting all-time highs, which means gold is hitting lows. What do you buy when you think a recession is coming? You gold, healthcare, energy, consumer discretionary. Those are the type of things that you buy. Okay. And so I'm not going to wait till it go up. I'm going to buy it when it's red, right? We buy fear. All right. Credit card balances are hitting all-time highs. Just think about that. That all has to do with this economy. OK, but this is what I want you new investors to know. Historically, this is the worst trading week of the year. Historically, this is the worst trading week of the year. So right. I believe, like I've been saying all this, all of the last 2 quarters, is that we could have a good Christmas rally. I was suggesting maybe 2 weeks into October, but because the Fed is so bullish, anything could happen now. Everything has changed. So earlier I showed you guys a report that says that people that start investing after the S&P has come down by 20%, actually years after, 2 to 3 years after the recession, they tend to do better. But remember, everything is not exact, right? So a lot of people always say, yeah, but this time is different. It's not all different. The same things tend to happen, but in different ways at different numbers. You understand what I'm saying? So instead of 20%, maybe it's 25% this time because the Fed printed so much money. Let's listen to this gentleman and we will go in further.
Appreciate you coming on. I mean, the market clearly, to Bob's point, oversold in the short term, but I don't hear anybody screaming optimism.
Well, no, not yet. Let's look at the dollar. The dollar is still gaining strengthening very strong. It's gaining against all other currencies. That's creating a problem. Yields are rising, and the VIX isn't. So we still don't have a capitulation going on in the markets, which tells me, painfully, we have more lows to go. We have more downside to happen.
For how long and how much?
Well, that's the magic 8-ball question, right? And so I would look for at least a 3,500 on the S&P 500. I think that's been said before. I'm not the first one to say that, but I've been looking for that since June. So the rally, very much a bull market rally. Those are common. If you look across other market cycles, think of 68 to 70, 76 to 78, 80 to 82. We have a lot of time left. And so, this could go on for some time. But I think the chances of recession are far more likely now because of the Fed and they're keeping the tone the same. They're not changing. And so I think we're going to have some more downside, and I would like to see that continue. Yes, we could get there quickly, but not without the VIX, not without yields, and not without the dollar. So I think it's going to be more pain a little bit longer ahead.
So he said more pain a little bit longer ahead. All right. And so let's look at a few things and let's see what he's talking about. Now, I agree with that we have a little further to fall. I also agree that there's going to be, unfortunately, a little more pain, but I also agree that this, for those of us that have been cashing up, will actually be a good signal. Remember, today is Moo Moo Monday. I'll come back to that later. Let's look at this. All right, so let's look at year to date. So remember how I showed you guys the report that people started investing 20%, negative 20% on the S&P tend to do well, right? So we know that was about here, about right here, which was about 37.90. Okay, so now let's go back 5 years, and I'm going to show you why this gentleman is, and a lot of people are saying 35. All right, so if we go back to the 200-day average, as you could see, it's about 35.85, right? So it's about 35.85. So what was this? This was COVID that hit. So if you see where the S&P was headed before COVID and then regained, you're about right there, what this gentleman is talking about 35. So what he's saying is, and this I kind of agree with, if you take out all of the Fed's endless printing of money and false prop-ups, if you take that away, the S&P is headed back down to about 3,500. Now, I know that, man, for some of you, that's a hard pill to swallow because you've just been watching this spiral, this slow spiral down. But remember, we have to look at the data and we have to understand that the Fed inflated. So the Fed did all of this inflation and helped to prop the market up. But also now it's the Fed giveth, the Fed taketh away. That's what it is, good people. And so it could come down to 35. Right now we're at 36.81 on the S&P. It could come down to 35 or to 35.85. Okay. And you know, there's all kind of numbers out there. Some people are saying 3,200. Some people are even more bearish than that. Right. But what does work right now, a lot of people are saying, well, which one should I do? There's not one way to make money in this market. I'm going to cover that in another video and just concentrate on that. But I do know that there's a variation of ways that you can make money. One of the things to simply be doing right now is dollar cost average. And I will tell you, right now, I'm not dollar cost averaging with all of what I'm dollar cost averaging in. Meaning, if I have 20 different stock and I'm putting $10 a day in this year, I'm going to take those same stock when the recession hits, and most of us think it's next year, 2023. We don't know if it's the first half of the year or the second half of the year. No one has that crystal ball. But when it does happen, then I'm going to go from $10 a day to $20 a day. I'm going to double down in my dollar cost averaging while the recession is going on. Okay. And that's what I'm going to do because I'm buying fear. You leave me a comment and let me know what you're going to do. So I just wanted to paint an overall picture and show that dollar cost averaging does work. But when the S&P gets below its 200-day moving average, which is 3585 or 3500, as this gentleman suggested, some people say 3480, you get it. Depending on who you listen to, the numbers are all over the place. And I'm going to have different portfolios. Some portfolios will just be value stock. And I'm looking for growth stock to come back. I'm going to be looking for the ones that are beat down and sold off the most. I've been saying that for a little while now. That is still my plan. I encourage every one of you to get a plan and stick to your plan, all right? And just trust the data and then move in your plan. But you gotta have a plan, good people. All right. Hey, today is Moo Moo Monday. And the reason why I say it's Moo Moo Monday is because in our Moo Moo account, we're simply cashing up. We're putting money in the Moo Moo link below. They have their most aggressive promotion to date with 15 stock. Just read it all. Follow the prompter, put some money in there, put a minimum of $100 in there. But I would be adding money continually because that's another place where I'm cashing up. And then, of course, with Webull, that's where we're doing our DCA, dollar cost average. You could do them. You can do it in whatever platform you choose. But that's what we're doing. Make sure you click the 2 links below. Let me know if this is showing a broader picture to you so it will help you in your trading decisions. Remember, when in doubt, zoom out. And just remember, look at this. Before COVID, after COVID, we're looking at about 3,500. And that's before all of the endless printing of money. All right. All right, good people. Make sure you click the links below. We'll see you tomorrow. Live, love, laugh, and learn.